past 100 years, the U.S. has endured 21 recessions. Here's a look back at the most significant downturns.
1907, a run on the Knickerbocker Trust Company starts a panic in a year-long recession. More than 150 banks are shuttered and the Dow plunges 46%. 1921, a post-World War I boom and bust spurs an 18-month recession and soaring unemployment. 1929, the stock market crash heralds the Great Depression. Unemployment reaches almost 25%, and by 1932, the Dow is down 90% from its high. After World War II, robust growth is marred by brief recessions, 2 in the 50s and 2 in the 60s. 1973, the Arab-Israeli War. The oil embargo and Vietnam War spending push inflation to 12%. The Fed hikes rates, causing the first severe post-war recession and rocketing unemployment. The Dow plunges 45%. 1980. After the Iranian Revolution, oil prices doubled, driving inflation to almost 15%. Fed Chairman Paul Volcker jacks up interest rates to 20%. In 1981, the economy skids into the worst recession since the Great Depression. Unemployment hits a post-war high. 1991, Iraq invades Kuwait and surging oil prices push the U.S. into recession again. Home building plunges 30%, while unemployment soars to almost 8%. 2001, the September 11th attacks strike an economy reeling from the dot-com bust. This milder recession also lasts just 8 months, thanks in part to Fed rate cuts that help prop up housing.
The big question is, are we in a recession now? The standard definition of a recession is 2 quarters of negative GDP growth. But official recessions are determined by a committee of 7 people. And so far, the Recession Dating Committee at the National Bureau of Economic Research hasn't called one. But let's look at some of the major factors they're going to be looking at. GDP, it grew 0.6% in the first quarter, but a large part of that was a rise in inventories. Personal income is up from a year ago. Industrial production is slowing, but still positive. And retail sales are up, though that includes gasoline prices. That's been sharply higher this year. On the bearish side, the economy has lost 232,000 jobs this year. That's the most since 2003, and the unemployment rate has moved up. My next guest has been on the record saying we'll skirt a recession. John Snow is former Treasury Secretary and chairman of Cerberus Capital. Also joining us is Roger Altman, chairman and co-founder of Evercore Partners. Gentlemen, I welcome you both. And John Snow, the first question to you. A couple months ago, you said no recession. Have you changed your mind, and what would you change your mind on?
No, Kathy, I think that there's still a good prospect that the U.S. economy will avoid a recession. As you say, a recession is normally defined by the National Bureau as 2 consecutive quarters of negative growth. We haven't had one yet. And I've heard now for nearly a year that we're going to have a deep and long recession. I think the pundits who've said that we're going to have a deep and long recession are likely to be proven wrong. They've fundamentally overlooked the inherent resiliency of the American economy, the responsiveness of the Fed, which I think has acted very appropriately in these circumstances and demonstrated that monetary policy is very effective. And then the actions of the Congress in the White House in putting together the stimulus package, of course, is helpful, going along with the fact that the American economy has many sources of strength, many shock absorbers, and as indicated by exports, and we're getting help by global growth, which will help sustain our export sector. So overall, I think there's still a very good chance we can avoid a long, deep recession.
Roger Altman?
Well, we don't know whether economic historians a year or 2 from now will look back upon this period as qualifying as a recession by their definitions, and particularly the National Bureau of Economic Research definition you referred to, or they won't. But for 95% of Americans, I think it is a recession. And by that I mean their incomes in real terms are falling. We've had essentially no growth now for the past 2 quarters. And the jobless rate, in other words, the percentage of Americans who don't have work, is at more than a 10-year high. So I think for most Americans it is a recession, and that's why you see consumer confidence plummeting. You see right track, wrong track analyses as severe as they are in terms of the wrong track being seen by 80% or so of respondents. And you see such general disquiet across the country. So I think if you walk down the street or in any town, and I know John is in Nebraska, so if he walked down the street in Nebraska and asked average folks whether we're in a recession or not, almost all of them would say yes.
John Snow, how do you counter that?
Well, I think Roger's absolutely right, that the essential question isn't whether what we're experiencing is technically a recession, but rather the effect of current economic circumstances on people's lives. High energy prices are a negative. High food prices are a negative. Rising unemployment is a negative. And the fact is, whether we're growing at 0.6 or 0.8 or even 1%, we're far below the growth potential of the American economy. And the important thing is that we get back to a level of growth that realizes the full potential that we're capable of.
Roger Altman, you're more concerned about the economy. Obviously, John Snow recognizes the risks, but he mentioned the rebate checks, the stimulus package, as one of the reasons he says we may avoid this recession. Do you think the government needs to do more?
Well, first of all, I think the rebate and the overall stimulus program, while welcome, and one has to commend the President and the Congress for acting expeditiously on it, is small. It's $168 billion. That's awfully small in a $14 trillion economy. So I think it's small, and its effect is going to be very small. And I don't think that's going to be the difference between a recovery or not recovery. In fact, I don't think it's going to have any real impact on that at all. Is it better than not doing it? Yes. Is it going to cause us to recover? Absolutely not. I think the forward-looking indices, like consumer confidence, suggest the next leg or the next move in this economic cycle is downward, not upward.
So what should the government do?
Well, you have, as John said, the Fed has acted aggressively and very skillfully. I agree with him on that. And a stimulus package like this is about all that you can do from a fiscal point of view. Now, there may be some additional steps we could take, for example, to directly address the housing and foreclosure crisis. I don't think the government's done much on that. There are many proposals pending in Congress that have been just sitting there. I personally would like to see more in that regard. And that's the crux of the problem, really, if you had to pick out one. But in general, I think it's going to be a slow recovery here because we started off with relatively low interest rates even before the Fed started cutting, and so the amount of monetary stimulus we have is a little less than normally you might. And second of all, the forces, and he just referred to a couple of them in terms of energy prices and food prices, are very stubborn. So I would think we're going to have a very slow climb out of this.
John, how is this affecting Cerberus? How are you surviving the slowdown? Clearly, the credit markets are a big part of this. You know, Main Street feels the mortgage crunch and the gas prices, but firms like yours who carry a lot of debt, clearly are affected by the credit aspect of this cycle.
Well, sure. Nobody's immune to the sort of turmoil we're seeing in housing markets and in financial markets generally. I think the biggest risk, Kathleen, we face today is the continuation of this credit squeeze. The fact that lending has, in many ways, come to a halt, and secondary markets aren't working. We're a long way from having normal credit markets. An American economy really depends on credit for buying cars, for buying homes, for buying consumer products. And if I had to single one big risk, it's that we stay stuck in this credit crunch. Because if it goes on much longer, I think we will clearly face a much longer and sharper fall off in economic output.
So this is something you feel in your business as well, John. Is that correct?
Oh, sure. If you're in the automotive industry, as Cerberus is, sales are down. If you're in the mortgage business, as GMAC is, you're facing the turmoils of the mortgage market. So Absolutely. There's no doubt about it.